Hey everybody, Preston Bryn here with our Traders User Group Weekly Roundup for the trading week ending June 14, 2019. Dancing in the rain is what price action is doing this past week. Let's talk about the world markets first. Most of them were in the green. In fact, just about every one was in the green. The London FTSE was up about 19 basis points. The CAC 40, that's the French index, just almost flat, really, 7 basis points up. The DAX, the German index, 42 basis points up. The Nikkei was up over a full percentage point. China was just slightly under 2% for the week. And here in the U.S., the Dow and the S&P up about 0.5% for the S&P, just slightly under 0.5% for the Dow. Russell was up about 70 basis points, a little under 1%, and the Russell was up about 1%. We saw volatility come down this week, end the week at 15.28. Last week it closed the week at 16.30. So volatility fell about 6% for the week. And we've seen the PE ratio, the forward PE ratio, which is what we really care about, is priced in right now about 17.26 for the forward PE ratio. The best performer for the week, sector-wise here in the U.S., was the material sector. I think it finished the best last week too. It was up about a little over 1% for the week. The industrials was the worst performer, coming in underwater about 32 basis points. So that's just kind of a real quick snapshot. But also, it's going to be a big week for central banks, folks, from the U.S. to Europe to Japan. They're all coming down from the mountaintops, and they're going to release their policy statement. And it's going to be led by our very own Power Ranger, Boom Boom Powell. He's going to step front and center. Press conference this Wednesday, June 19th at 2:30 p.m. Eastern Standard Time, telling us what they're thinking. And I'll tell you right now, big markets are making big bets that they're pricing in a rate cut. Probabilities for a rate cut this week are relatively benign, about 23, 24%. But that jumps up to 86% by next month for a rate cut. And the markets are pricing in 3 total rate cuts between now and the end of the year to a tune of 75 basis points. So I can tell you one thing: when the market's expectations are not met, they get angry like a petulant kid in a candy factory. So we got to be really careful there. And then on top of this central bank focus this coming week, we got the trade tariffs. Trump supposedly meeting with Xi the end of this month for the G20 around June 28th. And we got the Iranian issues in the Persian Gulf. So to me, as I said, the markets are dancing in the rain to the tune of "Don't worry, be happy." Now, logical arguments, I guess, can be made both ways: standing firm, holding pat, or cutting the rates. But if you look at the economy, we got low unemployment around 3.6%, rising productivity. We got consumer expenditures are rising, which is 70% of the U.S. GDP. Markets are really only a few percentage points from all-time highs. So that would suggest standing down from rate cuts, yet the bond markets are screaming for rate cuts. We've got an inverted 3/10, that's 3-month over a 10-year yield curves. We got, stats that are showing that the global economy is slowing a pretty good bit. And then, of course, standing in the middle of this is the U.S.-China trade war tension. So I'm looking at this year really almost like an election. Like the Brexit vote or the Trump election in 2016. It's like a binary event. If we have further escalation with U.S. and China, the rest of the year is not going to be very pretty, guys. But if that is resolved, and the markets are making a big bet that it will be, and if the rates are cut a little bit to kind of lessen the tension of the markets, and the markets are making a bet that that will be, then we're going to move higher. We're going to make new all-time highs. I'll show you the chart here in just one second. But kind of furthering that aim, there's a very high speculative number of short positions in the VIX futures, which basically says big money is betting that volatility is going to remain low, perhaps go even lower. So they're betting on more rate cuts. They're betting that the trade tiff is going to be resolved. And the last time we've seen this large of short positions in the volatility futures occurred last year in 2018. One was in January of 2018, the other was in September, and as we saw in both instances, the markets crashed. Volatility spiked. As those short positions are unwound, that only aggravates volatility to the upside and tends to push equity markets even lower. So, guys, if the Feds come out and they're being viewed as more patient or more cautious, the markets are going to interpret that as neutral to hawkish. And then the 3 rate cuts could be trimmed to 2, and the market's going to react negatively to it. So we've got to be very careful here. One thing that I'm looking at, and I saw this also in Barron's this weekend too, is a potential pair trade. I mean, the markets right now, it's kind of a coin toss, coin flip as to whether we're going to make new all-time highs, or we're going to go lower, and it's going to depend on these issues that I just talked about. But one way to play it is with a pair trade. Right now, we've got a pretty good divergence between the performance of the Russell 2000 and the S&P. I think they're like the difference over the past 12 months is over 12%. And according to some stats that I read out of Barron's, the last time that this underperformance of the Russell to the S&P to the tune of over 12% happened, it's only happened 5 times in the past 2 decades. The markets tend to revert. So that means the Russell will rise faster than the S&P will rise if there's good news, and then the S&P will fall faster than the Russell will fall if there's bad news. Either way, setting up for, I think, a really good pair trade. So for our members, we'll take a look at that using the IWM and the S&P as our proxies to see how to best play that kind of position. And generally, these things all resolve themselves within the next 30 to 60 days. So to me, I see that as a pretty high probability bet of making money, lower probability bet of losing, because generally these things come back in the line again. Okay. But if we look at the markets right now, you can see on the screen here, I have the S&P E-mini futures, and I've got it on a monthly chart. And I just wanted to show you guys a couple of things the way I'm seeing it right now. And this chart would seem to indicate to me that, yes, we can go higher. We've got this high in January 2018. We made a higher high in September of 2018, and we made an even higher high still this year. Okay. So when you're making a series of higher highs, that does not suggest, at least over the next 6 to 8 months, 10 months, that we're in a topping action that you would see with a bear market or the beginnings of a longer term bear market. What I would want to see is a lower series of highs, not higher highs. Now, this pullback here in Q4 was around 20%, 21% to the downside, but almost half of that, to the tune of 10%, was a Fed-induced error by our own favorite Boom Boom Powell when he came out December the 4th and indicated quantitative tightening is still on autopilot, and he sees a couple more rate hikes for 2019. All right, and that was in early December of 2018. That moved December to the worst month that we've had since 1931. So I think that was a bit overdone. I think it was a Fed policy mistake. So I would look at this as more of a 10 to 15% decline in Q4, not 20%. Okay, and on the monthly bar, you can see we closed up well off the lows. From the lows here that were 23.1675. And then in the month of January, we started to roll back over again until Boom Boom Powell came out and said, my bad. We're now view interest rates as being neutral, and we're going to slow down, if not stop shortly, our quantitative tightening. And then, as you guys know, the rest of the story, off we go. We make new highs, new all-time highs in the E-mini. So that is, and you may ascribe the move up here to just the Feds doing their reindeer games, which, as you know, they can do very well, right? And all of this, Boom Boom Powell had to do nothing. All he just had to do was just talk. So when he talks, the markets listen, as you can see, to huge movements. Now, I don't see a recession brewing, and I don't see a big downdraft here in the near term. Now, what really makes it a coin toss, as I said earlier, is, if Trump and Xi continue to act like little children and they don't have a more constructive tone, we're going to see the markets pull back a pretty good little bit. Okay. I still see this trend line holding up, and I'll show you that in just 1 second as we back out in time. But I see this right here as more opportunity to the upside and to the downside. And just to give you an idea of how much, if I were to kind of put one of my indicators on here, and let's just come way over here, you can see here it plotted this move very nicely. Okay, from January to September, it accounted for this lower level Elliott wave 3. And then if I do the same thing from here to here, you will see that it's plotting that we can run up to about almost 3,100, and that kind of is where I'm seeing the markets as well. If we solve the China-U.S. trade tiffs, if we get a rate cut or perhaps two, we've got another 3 to 5%, 3% to the upside, right? That we can run 4% to the upside up to 3,100. That'll get our multiples, our forward multiples up to about 18.5. And with very low interest rates, you can have multiple expansion in the markets fairly easy. Okay. So this would be on the good note. But if you flip the coin and it lands tails, not what the markets are expecting, where the Feds are a little bit more hawkish, they're not going to show 3 more rate cuts or even 2. They may just be more patient and wait and see. And we don't get a resolution, at least come back to the table with the China-U.S. trade tiff, then you're going to see the market start to sell off more, and it may force the Fed's hand. So right now, it truly is a coin toss, but I could see a path for running up to 3,100. Believe it or not, I could see that path very easily. If we look at our MACD here on this monthly chart, you can see with a series of higher highs, there's this divergence setting up to the downside. Now we've crossed back to the upside over the zero line, and that cross was done in March of 2019 to the upside. So we may run sideways, but I don't think we're going to run sideways for long because we're going to get some more clarity around the Feds and this China Trump Xi kind of thing. So I think we're going to break one way or the other. The markets are making a bet that we're going to break to the upside. As I said, such a large short position in the volatility futures would seem to indicate that's what the markets are expecting. And as I said, if the markets don't get what they expect, it tends to overdo the reaction to the other side, which in this case would be to the downside. Okay. Now, if I back this out, you can see this upsloping trend line. Let's go all the way to where it began, right here, right at the bottom down here in March of 2009. You can see this upsloping trend line. We don't have a monthly close below it, but we've come down and we've touched it 3 or 4 times. We almost touched it in December. We missed it by just a little bit. We missed it by about 25 points or so. So this is going to be my line of demarcation to, are we going to be going into now a longer term, meaning 6 months to a year and a half bear market where we're selling every rally? We're not there yet. And we could come all the way down to the 2018 and we can come down here. You can see the 2018 close at 24.86. So that's why we're up so much, because we started the year so low, right? So it kind of gave us about a 3 to 5 percentage point head start for the year, to be honest with you. But we can come almost all the way down to here and still be in the green. And the markets can be down, but we're still above this trend line. As long as we stay above this trend line, I'm okay with it. Okay. But you can see the huge divergences that are starting to set up. This would suggest that we probably got one more oomph to the upside, and then that's about it. Now that oomph may take us into 2020, okay, 2021, and then it's going to get ugly, because we're going to eventually break this down upsloping trend line, and then we're going to come down. You can see the value area here in this monthly chart, and it's sitting at 2,066. And I could see us coming down here very easy. All right. This move here from this Elliott wave 3 to this Elliott wave 4, while it may not look it, it was about a 16% drawdown, which is about the drawdown we had here if you take away Boom Boom Powell's misstatement. In fact, the drawdown in Q4 would have been not 16%, but maybe 12 to 13%, not quite as much. That extra percentage was when Boom Boom Powell misspoke. All right. So we could consider these two, fairly equal. So if I were to take everything off the screen, let's just get the indicators over. And then let's just use this point as an anchor point for a Fibonacci retracement. All right. And if I just come in here and I just come up like this and put it up like this, just to give you guys an idea, right? And let's just come right up to the top here. You can see a fib node retracement takes us down to the 2,500 area at 38 percentile, right? Which gives us, you'll see here, if I blow this up on the screen, you will see magically the monthly closing numbers are very close right here, and then down here we tested, but here's a monthly close, here's a monthly open, a monthly low. Right in this area here, to me, seems like a logical point if things start to get ugly. And remember, we can come all the way down to this area here, a 61% retracement, and still maintain our bullish bet here. If I put the indicators back on the screen, you can see taking us down to the 50 percentile takes us right down to that upslope and trend line. Okay. So normally when you start to exceed a 50% pullback, then it starts to get a lot uglier. But this just shows you that we can have these nice pullbacks here, clear out a lot of dead wood, allowing us to go higher. Okay. And at this point in time, if we get down here, then the Feds will be cutting like crazy. So this just kind of shows you where the markets are sitting right now. I do believe we still got more oomph to the upside, assuming we settle some of these issues. Okay. If we take it down to the weekly chart, we'll just kind of zoom in just a little bit closer. You can see the value area on the weekly chart, which goes back 90 weeks, is sitting right around 2788, which is where the most of the volume took place. And we're just north of that a little bit. We're at 2894, so maybe 110 points north. And that would kind of serve as a support point for us. But you can see where we hit my target here, and then the next target is somewhere up in this area here. Okay, so we're having a normalized pullback here. And if I were to put another fib node on here, and let's just do it like this, let's take everything off the screen, clear it up again, just to put another fib node, and I'll come to the bottom down here and come up here, remembering it was a little bit stretched. You can see here a 38 percentile move takes us down to 2714, but the more common 50% is at 2638. Okay. And you can see our pivot range here, which is system generated. You know, the pivot low is at 2859, call it 2860. The pivot high is sitting at like 2945. So we're in this chop range right here. Let me just get rid of these again so I don't cloud up the chart too much. And then if we come into the daily chart right here, you can see on the daily chart, we've had this huge move off the lows here. All right. And again, this was on Power Ranger Boom Boom Powell's statement at the Tuesday of last week, where he basically said they're open to looking at cutting rates. He didn't say they were going to cut them. He just said he's open to looking at them. Right. And the markets just immediately went up like this. Right. So we're now getting a settling in right here. It kind of, as I told our members, I said this kind of looked like, you know, before that happened, one of these kind of patterns, which tends to break to the upside. But we don't have a lot of room to run up here, and I think the market's going to remain quiet up until we get the Fed meeting on Wednesday afternoon. We get the policy statement, and then we get the language, and then boom, boom, Powell steps in front of the podium at 2:30 p.m. New York City time. And then we're going to get an idea of whether we're going to make a run up in this area here. I don't think we'll take this out, even if he's dovish, until we get through the Trump-Xi meeting, if they do meet. All right. But if they do, and that again seems like all he's got to do is say, we've picked up negotiations again. You know, Trump's going to be very hyperbolic. He's going to say it was the greatest meeting since all time and all that kind of stuff. We got to filter through that. I think the markets have kind of discounted that language. All they want to see is, are they getting back to the table? Is the tone more conservative, meaning constructive for coming up with some kind of dialogue to move forward? That's all the markets need. We're going to make new all-time highs. All right. If we don't get that, remember, Trump said if Xi doesn't show up, or if it's not good, he's looking at putting more tariffs on, you know, up to 25% up to 300 billion. The market's going to get ugly. We're going to come down and test these lows again, and it's going to force the Fed's hand probably even sooner. Right? So that's a little bit about what I'm looking at. Now, I did tell you the underperformance. Look at the daily chart here. This yellow line's the 200 EMA. The red line is the 50 EMA. Clearly, the 50 EMA crossed the 200 EMA back here in March. And we've got some separation, and both are turned pointing upwards. That's a bullish sign, right? Now look at the Russell. This is the underperformance between the two. Look at the 200 EMA. We're below the 200 EMA price action. Look at the 50 EMA. That's below the 200 EMA. Price closed the week below the 50 and the 200 EMA, both of them pointing slightly to the downside. That's underperformance to the tune of, going back a year, almost 12%, 13%. So this tells me that a pair trade would be very nice. For our members, I'll review this with you guys Sunday night. What would be a good way to play it? Okay. We almost came up and hit my target up here, missed it by about 10 or 15 points. Notice we made 2019 highs, but we didn't make new all-time highs. They're up here at 1746 that were made in September. So the Russell has not made new all-time highs. And the other one that has not made new all-time highs is the Dow. If we look at the Dow, again, we've had this nice run up. We broke this downsloping trend line. We made 2019 highs back in May, right at the beginning of May, before I was getting everybody hedged to the downside, right? But if we look at all-time highs, it was made again in September. So the only indexes that have made new all-time highs is the S&P and then, of course, NASDAQ, because NASDAQ made new all-time highs again around the same time, early May, before the markets just kind of cratered, right? So we're sitting here watching this, and if we, of course, if we look at the my FANG index, which I've kind of combined here, you can see we've got all-time highs in the FANG index also in 2019 in April, before the markets rolled over, and now we're bouncing here too. But we're getting some leadership in other indexes, other stocks rather, and I think mostly in the software side. Collaborative software side, we're seeing cloud-based stuff. They're moving pretty good as well. So, and the FANGs are stuck between two big value areas, as you can see here. So we're going to be chopping around here. The markets are looking for direction, looking for leadership, and we got the U.S. government going after Facebook, Amazon, and some of the others, Google, on antitrust issues. So there's some battles going on there as well. Not as much Amazon as it is Facebook and Google, but I think Amazon will probably be added to the mix. So we got some issues there. We got some individual stocks that we're looking at. Members, I go through with you. We got some great opportunities. The IPO market is hot. We've seen some moves up in some stocks that I think are a little bit overdone that could be shorted to the downside. We look at the treasuries, look at bonds, guys. This is the one I wanted it to go up a little bit higher so that I can short it up here. I'm not going to short the bond market before a Fed meeting. That would be suicide. Flip a coin, But after the meeting, once we get a kind of clarity around this, if the Feds are going to be dovish, I think you're going to see the bonds move up even higher. Okay, and I think it'll kind of weaken the dollar, and that'll also strengthen gold and some of the other commodities. So that's kind of what I'm looking at in the bond market. And if we look at interest rates, good Lord, they're low. We're down here hugging the lows, and it could go even lower if the Feds are very dovish this week, which I think is helping expand PE multiples and putting money back into the asset or into the equities as an asset class. It allows margin or PE multiple expansion, I guess. And you can see here we don't have any divergences here, so this would suggest that any move higher is going to move lower the interest rates. Okay. And again, speaking of currencies, you can see the dollar here. It had a good day Friday. It moved right back up to the center of this channel, this regression channel. And if I back it out, you can see it's very wide, but it's clear the direction that it's going. Money is coming into the United States big time, right? Or as Trump would say, big league. It's coming into the United States, and it's going to continue to do this. And this has gotten Trump's ire. He wants dollar weaker, right? But that's what's happening right now with the U.S. dollar. And of course, the euro is just the opposite. If we take a look at the euro, it's going to be the same trend line, but going in the opposite direction. Remember what I've said, it's really not the dollar currency. It's more a dollar index that's tracked against a basket of currencies, of which the euro is about 58% of the entire dollar index. So when the dollar's going up, you got it, euro's going down. Now we're coming down in this area here, which would suggest we could see the euro come down even lower. I think over the next decade or two, I think the European Union as a a group of states trying to act together is almost, it's just not going to work. You've got states in the southern, or countries in the southern part of Europe that are more socialistic, countries in the northern part that are completely governed entirely different, the way they run their budgets, the way they run everything, and trying to center everything German's way, it's just not going to work. All right. They've held it together pretty good. I give them a lot of credit, but I just think Bernanke, I'm sorry, not Bernanke, but Power Ranger. Geez, I'm getting all my central bank guys mixed up. But Super Mario Draghi running the ECB, it's going to be real interesting to see. I don't know where he's going to go. Interest rates are already below zero or flat, right? And the German Bund yield is well below zero. It's the lowest it's been in a long time. That would suggest the euro's got problems, all right? This is where we are with the currencies. Now let's look at one of our favorites, which is oil. I mean, even with the flare up in Iran, you can see oil. You would expect 10 years ago, oil would be up $5, $6, $7, $8 a barrel, but because the U.S. is producing all the oil that it's doing right now, oil independence is a strategic issue. You can see I had called this move to the downside, I'd call this move to the upside, and I'd call this move to the downside. So we've got some members making some serious coin. It's $1,000 a point in the futures market. Now, where is it going to go from here? Well, right now there's a no trade. All right, we're kind of in the middle of the range from the lows down here to the near-term highs up here in late April. So I just think we're going to chop around here until we get some more clarity on the Feds and on the China trade tiff. I will tell you, if the China trade tiff is solved and interest rates are going to come down, you're going to see oil scream right back up again. All right. And then it'll probably roll back over again, because then it's going to be a demand issue versus a supply issue. And what's moved oil down is more of a demand issue than a supply issue. Although we've had an oversupply of oil, I just saw oil being a little bit better naturally fitted and suited to the mid 50s. So anything away from the mid 50s has either been a short or a long until you get back into that value range again. Right now, there's a no trade. Let's just see what it wants to do. Okay. And then, of course, if we look at metals and we look at gold, let's just back it out a little bit. I'm going to put it on a weekly chart so you get a little bit of a better idea of what I'm looking at here. Let's do this. Let's bounce it back. Okay, this is a monthly chart of gold, but you can see here, kind of where we're sitting. I could take this chart and just as easily, let me just move this down like that. I can come down like that, and just to capture that like that, right? So you can see this monthly chart of gold, and we've had this tremendous divergence going on, which would suggest it wants to break to the upside, right? I've got a little target indicator here of around $1,400 an ounce. And you can see we're in this area here. And as pressure builds up, it's going to want to break. This is an ascending triangle, which would suggest it would want to break to the upside, right? Not ready yet. The key level that I'm looking at is around 1365, 1370, because we could roll back over again. A big part of it's going to depend on what the Feds want to do. Of course, if we come back into the weekly again, you can see here where we're sitting. We're coming back up. Here's my target. If we break this level here, which is around 1375, then we're probably going to have a retest of this level. And again, this is for a long-term trade. All right, I'm looking out the next 3 years, because when we roll over, the markets finally roll over, I'm projecting gold to run back up to 1700 an ounce. But I am not by any means a gold bug. These guys calling for gold at 5,000 an ounce and all. They've been calling it for the past decade. Eventually, even a stop clock is right twice a day. But when the trade opportunity suits it, then I think it's going to be ready to jump in. All right. Now, one of the things I've been doing is trading silver. I have been in silver for a long time, and it is underperforming gold dramatically. If we look at this weekly chart, let's just blow it up here so you guys can see a little bit better. You can see it's dramatically underperforming gold. And part of the reason is, and we're almost at a value area in silver at 1380, right? And I think silver closed at 1391. So we're right on this value area. So to me, you can see taking long positions in SLV if you just want to buy the stock or you want to go long silver. Longer term, and I define longer term as not a 30-day trade. I'm looking at it 2 or 3 years out. I think silver is going to be north of the 15, 16 area. And because the price is so low, it doesn't take a big move to get a huge return on your invested capital. The next value area for silver is sitting right around 15.53. So, you're looking at a little bit less than about $1.40 move, right, on a 1391 price right now, and in the futures market, that's a big move. Okay, so that's kind of what I'm looking at for silver, but I think gold is going to be a good play. The other one that's going to be a good play if you want some more juice, and it would be not necessarily in gold, but the gold miners, right? And I wouldn't do the junior miners. I think, you can see right here, we're coming right up to this key level, very similar to gold. We've moved up off of these lows down here, up into this area right here. We're going to test it. I want to just see how it reacts. The value area for where most of the volume took place to kind of where we're equal between the bulls and bears is around 22.26 right now, right? So I want to just kind of see where we end up here. If we break this area, again, my target, just like with gold, but here with the miners, is up around 24.50, near-term target. All right. Longer term, I think this has got a ways to go to the upside. All right. Now, for our members, also, we had a great trade in palladium. We took a short in this area here. It worked out to about $25,000 to $30,000 a contract in about 3 days. All right. And we had some members that made the play, and it was really great trade here. High probability trade too, by the way. But you needed a larger size account to trade it because Palladium doesn't have options. So that told us that the downside was going to be ugly because the longs could not hedge their long bet with the options market. So they just meant longs were going to abandon their position very quickly, which they did. And it gave it all up really quick. Now look at it. We're running back up again. I want to see this break out of here and make another run. All right. And we could set ourselves up for another opportunity here, for another downside bet. Not ready right now, but let's watch. Corn is just getting killed if you're short. But the long position here, as I said, I remember when it was pulling back like this, I said I wanted corn to go higher, which I think it will. And it's doing that on the basis of the flooding in the Midwest with the corn crop. So I think it can go even higher. So I'm going to stand down, but I want to look at it as a possible short. I think corn can run up here at least to the 480 to the 5 area. And then once we get up here, I'll be interested in looking at taking it to the other side. Okay. Same thing with wheat and soybeans, right? We've got this big, huge move higher. And if we look at soybeans, which is more affected by China, you'll see it has not made the big move off the bottom that the other two have. So I like the corn play probably the best right now in the market. And then, of course, if we look at lean hogs, this was our when pigs fly short. Right here, we took the trade right here on April the 9th, shorting lean hogs. For those of you that are not members watching this, I'm telling you guys, it's just a few of our trades, and you'd be up 50, 60,000 in futures contracts right now, just doing just 1 or 2 contracts on these trades. So they're designed really not for someone that's got a small account. If you've got a larger size account, you can. Now you can trade these with a smaller account, but we're doing them just the futures market. So you can see where we're coming. Now, if you miss this trade, as I told our members, if we break the 80.75, I think we'll have a nice quick run down, probably another retest of the 85 or 80.75, and then maybe lower. It depends on where the swine flu issue goes. But as you know, the last big money that we made here was also a when pigs fly short position, because pigs can't fly, right? And we did that, and the culprit was swine flu again, only it wasn't China, it was swine flu here in the US. And it actually caused an even further aggravation of the lean hogs to the upside. Right? Now, there's other things going on in the softs market and other stocks that we're looking at, but this is kind of where we're sitting right now. For members, I will see you tomorrow evening. We just finished another great session in our Option Masters on how to trade the markets, whichever direction they're going in, because sometimes your core trade should really be positioned regardless of what the markets do. You should be able to make money. All right, and I'm working with our members on how best to do that. If you're not a member, I highly encourage you to come in because it'll pay for itself, probably 10x over. Otherwise, folks, have a great evening, great tomorrow, great weekend. Members, I will see you this Sunday evening. Ciao, folks.